Good morning, good morning, good morning. Oh goodness, it's 9:10 and I've already had a tremendously busy day, but I needed to get my coffee and I was trying to upload to the paid version of StreamYard. So, because it gives you, instead of it being in 720, you get 1080. I think it's clearer. I know last night during the call, some people or someone said they couldn't see the numbers on the presentation. So I wanted to try to upgrade. But for some reason, it hasn't gone through yet. So we're just going to get started. If anyone is here who can hear me when I share my screen, good morning, Clodo. Love that name. um, so when I share the screen, if it's hard for you to see, um, I apologize. But the next one, the next time I do this, you won't see this powered by, it will be the paid version of StreamYard. And hopefully that'll make it a little clearer. So, good morning. And let's get started. So, I said I already had a pretty busy day. I did my accountability group this morning. I had a list of things to do. Um, that I need to get done. I have some projects I need to complete. So I sat in there for about an hour and got some things checked off my list. I had a coaching call already. So it's been a pretty busy morning, but what I did not do and what I like to do, so bear with me before we get into the numbers, I have to set my day. I truly have to set my day. And this book right here is a must read. It's called Ancestors Said 365 Meditations for a Peaceful Year. So I decided I'm going to read it with you guys. Um, I've given this gift to so many people. This and stocks are my go to gifts for 2023. And so I'm going to read December 13th out loud. Once you overcome your issue with being seen, you'll unlock a new type of blessing. As the ancestors in this book, I've actually left the link already. I put that in. Another reason why I'm a little late, because I tell you, let me read that one more time. Once you overcome your issue with being seen, you will unlock a new type of blessing. Now, I'm not going to break it down because that's not what we're here for. I might do another video. Actually, I'll do an end of the year video about this book. It's one of my favorite gifts to give. It's called Ancestors Said 365 Meditations for a Peaceful Year, and it's by Ihime Ora. And I have the copy, the hardcover, which is a little tattered. You probably see fingerprints and all of that. But anyway, let's get into the money, honey. Let's get into the money. So today I wanted to do two things. I want to walk through some portfolios, do analysis from like a 5 year, 10 year, and 20 year perspective. If anyone is hearing me, and welcome to the people who are watching the replay, but if anyone is in here now and wants me to look at any particular companies, I'll give you 60 seconds to put it in the chat. Well, go ahead and put it in the chat. And if I don't see it before I do the first one, I'll come back and look at it later. So I'm going to do an analysis of that. And then I'm also going to do the question came up yesterday about ETFs. So I'm going to start there, showing you how to, um, how to find ETFs that may work for you. So I'm going to start with that and then get into the portfolio analysis. If you haven't checked out the other videos where I do how much you would have made, those, if they're not connected now, they will be in the chat as well. But check those out. I show you how $500 in 5 years could have turned into 20,000 or 30,000. $1,000 could have been 40,000 or 80,000. With Tesla, it would have been 80,000 in 10 years. Good morning, Monica. I see you're here too. So I just mentioned I'm going to start off with the ETF. Um, the ETF database and how to find out, what companies are in what ETFs. If you do not know what an ETF is because you didn't see the other classes, go ahead and check out part 3 of Investing for Independence. It's towards the end, and you can see exactly what an ETF is. But I encourage everyone to watch the entire 3-part series of basics of investing in the stock market. So let's get started. I see Clodo put Apple. We did Apple yesterday. Remember, that was the one that if you would have put the $1,200 in for 10 years, which would have equaled 12,000, that 12,000 would have been worth $65,000 now. That was Apple. But again, we can review that as well. So let me go ahead and share the screen. Hold on. First, let me pull up the ETF database. And then I'm also going to do one day this week. I'm going to walk through the toolkit, the beginner's toolkit, and we're going to walk through how to research a company together. And we'll, take an example. So if you have any examples, put them in the chat or put them in the comment section. And I think I'm going to target, it might be tomorrow. I'm thinking tomorrow evening. Tomorrow evening, I will probably, because I have doctor's appointment. Okay, yeah, so probably tomorrow evening. So let's just go ahead. Let me go ahead and share this screen. And I mentioned that I'm going to upgrade the StreamYard between today and tomorrow. I tried to do it before this meeting, but it didn't go through yet. It's not active yet. And so once I do that, hopefully whenever I put a presentation on the screen, it'll be in a higher quality. So you'll be able to zoom in on the numbers better. So let's hope. Okay. Let's see. Oh, and do me a favor, like this video. It helps it get pushed out to other people. Just put a thumbs up. And if you haven't already, turn on the notifications so that you'll know when I, go with more lives, which are going to be more frequent as it relates to basics of investing. So, okay. So present. Oh, got to find share screen. So different from Zoom. So give me a second. Is this it? Yeah, this is it. So hopefully you can see that. And we are currently on ETF.com. Nope, you can't see it. Why can't you see it? Okay, hold on one second. It says stop sharing. Why does it say stop sharing if it's not sharing? Give me one. I'll figure this out. There we go. Okay, so hopefully you can see the screen. We're on ETF.com. And so since Clojo put Apple for the portfolio review, I'm just going to go ahead. You know what? And I'm going to come out of might lose audio. So it said I would lose audio if I took myself out. Anyway, so I'm going to keep myself in. And there, there we go. There we go. Hopefully you can hear me. If you can't hear me, please put it in the chat. But when I tried to take myself completely out, it said I would lose audio. All of this is new to me on StreamYard, so let's proceed. So I'm just going to go ahead and go to ETF.com. As you can see, it's right here, ETF.com. And let's say you're like, okay, I want to start investing, but I'm not sure what companies I really want to buy, but I do like Apple. So let me see what ETF Apple is in. And just as a quick summary, ETF stands for Exchange Traded Fund. It's a fund that moves like a stock. It acts like a stock. So you can buy one share of a particular ETF. Within that ETF, though, there are multiple companies, and you don't have to work in a particular category. So let's just go ahead and do Apple. Oops, AAPL. I know that's the ticker. AAPL. Okay, what is going on? Sorry, y'all. Let's do AAPL. Is this not? Okay, here we go. So there are 403 ETFs that have Apple exposure. So what we're going to do is just click on the link, right? What we want to look for are the ones that have the highest percent allocation. So you don't want to, if the main point of you picking an ETF is for a particular stock, you want that stock to have a high percentage holding within that ETF. You don't want that um, ETF to only own, like, to only represent 0.3% of that company. So you see the percent allocation here. ETFs with the most Apple exposure. Then you also have top performing ETFs with Apple. But that's just, like I said, we're investing for long term. So we want to look at the ones with the most exposure first, because it's gonna move more like the Apple stock. So if we just pick XLK, I'm actually an investor in XLK. Um, it will break down the current price of XLK, which is $133.77. It gives you its performance over 1 year, but we all know 2022 has been a bust for a lot of stocks in the market. So it started way up at 172 and it fell as low as close to 120, maybe a little lower, but it has room. That means, the capability of it running back to 170 something is there, right? Um, and then we're going to, it gives you insights and analysis, but we want to see what else is in XLK. And so, and it also gives you a 5-year return on XLK. And that's, I think, when we start talking long term, you want to look at that as well. Tremendous growth. In 2018, the ETF was worth $64, $65. It ran as high as $175. Now, when I spoke yesterday about your investment plan, buy low, sell high, this is not where we want to look at it getting in at the highest of the high. Now, because you see what happens. It goes up, and I talked about this, comes down, goes up, comes down, goes up, comes down, runs up, it comes down. So you're going to have these type of movements. You want to make sure that you don't have to get in at the lowest of the low, but I mean, this may not be a bad entry. Let's look at max for the ETF. And let me see. Okay, there's the max. And so you can see it goes up, it comes down, and then runs up. And the good thing about these charts, is it shows you how the market works. And we talked about it. So when Warren Buffett said in the video yesterday, and if you didn't watch part 3, watch part 3, when Warren Buffett said, if you buy a house worth $20,000 and somebody comes along the next day and offers you $15,000, you're not going to sell it because you know the value of the house. You invest for a long term. A lot of people would have gotten nervous, maybe jumped out. This is the time where wealthy, they're buying it up. They're buying it up because they understand that this, in the long term, 10, 20 years, is going to potentially, more than likely, pay decent rewards. And so let's get to, they changed their screen. So let me just try to find where they do the breakdown of all of, okay, XLK. So it tells you, excuse me, the top sectors that they're, the top holdings, excuse me. Here's the top holdings. So let's go to view all. Holdings used to be first, y'all, so forgive me. And you used to have to click completely on it to see it. Now it just pops up, which is beautiful. Okay, so um, in the top holdings, that means the top companies in this ETF, and it's broken down by percent allocation. What percentage of this ETF belongs to a particular company? And I'm going to explain, and I think I may have done it in the second class, but NVIDIA, oh no, I did it in one of the if you would have invested videos. But NVIDIA is one of my favorite companies. Microsoft is another. Apple is another. Um, there was a couple other. Visa, sorry, is another. So let's look at the allocation. Microsoft represents almost 22% of ETF. Apple almost 22%. NVIDIA 5%. Visa 4%. Mastercard 3.5%. And so understand that when you look at the ETF, you're looking at one, the highest allocation companies, the companies with the highest allocation, because that's really what's going to make the stock go up and down. So if Microsoft and Apple have a bad day, guess what? That's 43%, 44% of this stock. This stock is going to have a bad day. But when Microsoft and Apple have good days, then the stock will move accordingly. And if you are a believer in companies like Microsoft and Apple, this may be an ETF you want to invest in versus investing in individual stocks. You don't have to worry about the management of the stock. So like the guys from EYL said yesterday, I think it was Troy, he said, think of it like a all-star team, right? You have LeBron, you have Anthony Davis, you have Steph Curry, and I don't know who else he mentioned, but let's just say LeBron gets injured and he cannot play. You still have other companies holding it up, right? So let's just say let's just say Microsoft has a bad day or can't play. Apple is still in play. So that's the Steph Curry or Anthony Davis or whoever you want to equate it to. But the great thing is that you don't have to worry about one stock going out of business, going up and down. And then there's a company, the company that manages this. Does it list it up here? Let me see. It should in the summary. XLK tracks an index of S&P 500 technology stocks. Now, you may be saying technology stocks. Wait a minute. I saw Visa and I saw MasterCard. A lot of you guys don't know that some of these financial companies also share the category of technology because Visa, I think they own Square. But make sure that, well, I won't say make sure, just know for future reference that a ETF tracks a certain or one specific category. And for XLK, it's technology stocks. And so I wanted to see the owner of XLK, the company wise. Okay, it's called State Street Global. And so State Street is known for a lot of X's. They have XLK, XLY. XLY, I believe, is the one that has Amazon, because I'm going to look that up next if you want to invest in Amazon. But these are reputable companies who have been in business for a long time. They have high volume. And the inception date was 1998. That's key to know. Let's just go over the data for um, the ETF. So the issuer is State Street Global. You can Google them to see, what a summary of what they say on Investopedia. Investopedia is a great reference site for all of this information. The fact that it was, you know, created in 1998 shows that it's been around for what, uh, a long time, 30, 34, 35 years or something. No, 40 something years. Oh my gosh, my math is horrible this early in the morning, but that's why I say use a calculator. Expense ratio is only 0.1%, which is really low. You don't want anything more than 0.75% because that's just a fee that comes out of your investments and assets, which, this is how companies make money. We understand that, but some of them are anywhere from 1% to 3, higher. You don't want that. And look how much they have, over $40 billion of assets under management. So that means they move a lot of money. It's not a small company. They track the S&P 500 technology sector, and that's the key information you want to know. I'm going to do one more example. I'm going to do Amazon to see, because that's a popular one. Let's see where Amazon. You can find an ETF that has Amazon. 347 ETFs with Amazon. Let's go click the link to see what they are and the top ones. Mm. So, ETFs with the most Amazon exposure, ONLN is one ETF that, and you buy it like a share. So they have tickers just like shares, like stocks. XLY, consumer discretionary sector, which I own. Um, and then there's others. So we can go into, let's try looking at the Fidelity one. So Fidelity is FDIS. And that, I'm going to just click on that. So you can get a vantage. Now, like I said, 2022 has not been a uptrend movement with most stocks, most technology stocks specifically, and a lot of other stocks as well. But let's see what it's done over the max time frame. Okay, so we look back at 2014, where cost was um, the cost was $26, almost $27. And look, it's in 2021, it ran up to $90. That's 3 times an investment, or close to. It closed over 2 times, more than 2 times. I said 25. Yeah, a little more than doubling your money in 2022. But again, this is how the market works. It did a big dive here. It did another dive here. And this is how the market works, like I said. So let's just see the issuer's Fidelity, very reputable company. It was the inception date, founded, launched in 2013, October 2013. The expense ratio is 0.08, which is even lower than the XLK that we looked at. And it's over $1 billion in assets managed. And then it's Fidelity. So the great thing again about reputable companies, it's less risk. It's less risk for the investor. So it gives a little bit more insight about FDIS. Delivers exposures to large and small cap companies. We learned about small and large cap companies yesterday. So check out part 3 if you missed it, to really understand what that means. But they focus on the consumer discretionary sector. So we're going to see what companies they invest in. Amazon, Tesla, Home Depot, McDonald's, Nike, Lowe's, Starbucks, TJX, Booking Holdings, Target. A lot of my favorite brands, let me speak for myself. And the heaviest weighted companies are Amazon, Tesla with double digit, McDonald's 7, almost 8%. No, excuse me, Home Depot almost 8%, McDonald's almost 5%, Nike 3.5%. So high quality companies, best in class companies are part of this ETF. So I'm going to stop sharing, see if there's any questions before we go on to portfolio evaluation. Let's see. 24 years. Monica, I don't know what I might have said something and didn't know exactly what that 24 years. Oh, when I was calculating. Thank you, thank you. What did I say? 30 something years? Oh my gosh. I try to base everything on like acceptance to college, graduation from college, stuff like that. So thank you for that. Okay. So let's quickly go to the portfolio management or portfolio analysis. One second. Okay. It's called the Portfolio Visualizer. So let me pull that up. And before I do that, I just want to reiterate that the toolkit that we will review, because I brought that up earlier. So if you're watching this for the first time or you didn't remember exactly what I was referencing, let's go ahead and show you what the beginner's toolkit will look like. Share screen. Here we go. So this is what I'm going to review probably tomorrow night. Again, come to the YouTube channel, turn on your notification, and you'll get alerted. I'm going to try to schedule after this call. What time is it? Yeah. After this call, I'm going to try to schedule it and you'll know what time tomorrow. And it'll be, again, I'm going to try to keep it under an hour, probably shorter, depending on how many questions you have. But this is the beginner's toolkit. I call it the blueprint for research. And these 5 sites, including the ETF.com site. I can add that as well if that's what you're interested in. Some people, not everyone's interested in ETFs, but these 5 sites will prove invaluable. So CNBC, but I also said yesterday /Bloomberg. Bloomberg does have a paywall, so you may have to pay if you are interested or that serious or prefer Bloomberg. I like Bloomberg a lot. I like their format, but you don't have to pay for anything. So that's what I really want. That's why I didn't include it. But Bloomberg.com is another source. Google Finance, free and easy to use. Yahoo Finance, free and easy to use. Bar chart, free and easy to use. The company website, free and easy to use. Investopedia, free and easy to use. So tomorrow I will do a walkthrough of a company and Apple. I'll start with Apple because Clodo put that in the chat. So I'll make sure I start or include that tomorrow. But let's just go ahead and do the back testing. Let me see if you can see. Oh, you know what? I don't think I was sharing that. Was I not sharing that? I was not sharing that. I'll do a quick visual. That wasn't the chart. I'll do a quick visual of okay. So yeah, so that's the quick visual. CNBC, Google, Yahoo Finance, bar chart, company's website, Investopedia. I think you. Why is that not? showing on my screen. CNBC, Google, Finance, Yahoo Finance, bar chart, company's website, encyclopedia. I keep pressing it, but it's not going through to share, and now it did. So anyway, let's go move along, and I'm going to make sure that this, before I start speaking, I'm going to make sure that the portfolio analyzer, also called back testing, is popping up. Okay. Okay, let me see. You should be able to see that. Hopefully you can. Yep. So it's showing up on my screen. So um, let's just walk through. So it's called www.portfoliovisualizer.com backtest / backtest hyphen portfolio. And what it does, it backtests any investment portfolio that you would want to put together to see what type of returns you would have received. It starts in 1985 and it goes all the way to 2022. You could do a month to month, you can do a year to year. We're going to stick with year to year because we are not short term trading. We are long term trading, and long term trading is 366 days. So 365 days plus one. So let's go ahead and put together a portfolio. So let's start with a 5-year portfolio. No, you know what? Yeah, no, let's start with a 5-year. So we're going to start in 2017 to 2022. We're going to include year to date. That just means up until the latest. And they have information to the side so you can understand exactly what each line stands for. I kind of warned you guys there's construction going on outside of my house. So please, if you hear anything, forgive me. So year to date just includes the month to date period of the calendar month for the year to date results. Year to date up till now, we know what year to date is. And initial amount. So let's just say I don't want, I want this to be attainable. So if we put, let's say you got your income taxes back. Let's say you got income taxes, right? And you got your income taxes back. You took $1,000. So we're going to turn that into 1,000. Um, there's no extra cash flows, and all of this will specify withdrawals or contributions are done. No. Well, yeah, you know what? I'm sorry, we are going to do cash flows. We're not going to just do one investment in 5 years. We're going to do $1,000 initial investment. We're going to contribute a fixed amount. So again, we don't have to, I'm going to say $50 a week. So that would be $200 a month. We're going to adjust for inflation. The contribution frequency is monthly, $200 per month. You can edit as you see fit. I want us to um, start thinking a little bit more aggressively with our investing, and $200 can be made at a part-time job. $200 could be made selling Avon. $200 can be made to invest on a monthly basis if you feel you don't have it now. There's ways to get it. You can sell stuff on eBay that you're not using. Look around your house, look in your closet, things you haven't used. There are ways to make $200. And so rebalancing is when you basically switch things up at the end of the year. We're not going to rebalance. We're going to keep everything the same. And the rest, we're going to reinvest our dividends. So if there's any stocks that we choose that pay off dividends, then that money's going back. You're not taking that out. That's going right back in your portfolio. And the rest of this you could keep the same. So let's just think of 5 companies. So let's think of 5 companies that we want to invest in. Let me see if there's anyone who's, nope, no suggestions, which is fine. I'll just walk through this as quick as possible. And I'll do that by, you know what? Unilever. And they make like Vaseline, they make Dove hair products. We're going to do, I'm trying to think of, I'm looking around too. Oh, let's do Microsoft. Let's do Sony. So if anyone has a PlayStation or their kid has a PlayStation, let's do, trying to pick different categories. Let's do JP Morgan, which is a bank. Let's do I always like doing beauty because I know women spend so much money on beauty. And we can even do Nike. Okay. So there's 6 companies that we pick. When you choose the portfolio, when you drop down, you want to pick equal weight. That means when you invest your money, it's equally being distributed fractionally to these companies. So let's stick with equally weight. And then let's see how much that investment would have been worth today. So you did an initial investment for $1,000. You added $200. So that's $2,400 for 5 years. Maybe 11,000. Hold on. Let me get the calculator. Oh, actually, I think it may break it down here. So let's quickly look at the breakdown. It just shows you. I just love this. Look at the beautiful way compound interest affects your stock portfolio. Even with the dips in the market, there is no other investment, maybe real estate, if you pick in the right area and it all of a sudden gentrifies, then yes. But very few places pay off these type of returns. And you can see, even with 2022 being a down year, the amazing growth that happened over the 5 years. So it tells you over 5 years, we're looking at about a 14% return. And it also breaks it down more, but you could read this on your leisure. I just want you to get the gist of what you could have made in the stock market. And it ends November 20. That's the latest data they have. So the ending time for year to date is November 2022. So it does not include December, which we're in the month of December. But it shows you the best year that you had, what returns, your return of investment. It also shows you your worst year, but it washes out when you pick valuable, sound companies. And like I said, tomorrow we're going to go over researching how to tell if a company is sound and is worth you investing your money into. And so, yeah, so this is just a quick view. But what I want to do is, so we saw that if you did that for 5 years, portfolio would have returned, what was it, 13%, 14%, um, right, for a final balance of 24,000. Let's say we did it for 10 years. The same companies, the same stocks. So we're going to go to 2012 and we're going to hit analyze portfolio. It's going to recalculate same companies: Unilever, Microsoft, Sony, JP Morgan Chase, Ulta Beauty, and Nike for 10 years. This is what I mean by long term. It didn't just double, right? It didn't just double your money because we were at 24,000. Now, keeping that same $200 investment monthly coming directly out of whatever check or whatever, um, however you want to do automatic payments, that initial investment plus your $200 a month would have been worth almost $80,000. $80,000. And we're talking by investing. So if you think about it, 2,400 times 10 is 24,000 with an initial investment of 1,000. So let's say 25,000. Your 25,000 would have gotten you $80,000 by investing in sound companies that you believe in. Let's see if we change the same time frame to 15 years. So instead of it being 2012, we're looking at what, 2007? 2007 to 2022 using the same companies. Now, I'm not sure if Ulta may get dropped off one of these times. Okay, so not this one. But 5 extra years, that $1,000 plus $200 per month in 15 years would have been worth 180, I'm going to round it up, $87,000, with your worst year still being a negative 40% return. But look, your money was still growing and compounding and paying off beautifully. This is your worst year right here, 2008. Remember, I talked about that. I think it was yesterday, and maybe so part 2, part 3, that was another crisis when the market tumbled. And yes, it was a 40% hit the year after you started investing. A lot of people would have got scared and stopped investing. But guess what? They wouldn't have taken advantage of all of these gains. All of these gains. And that's why long-term investing needs to be a part of everyone's um, income streams. Like long-term investing just needs to be part of it, period, point blank. If you can invest more, then fine. I have a friend, we went out to dinner. She joined Basics of Investing when it first started. We went out to dinner about a month and a half ago, 2 months ago. And she was telling me she has literally made a commitment. She invests $250 per month per child so that her kids, when it's time for them to, get out in the world, or um, she's keeping them competitive, basically. She's making sure that they're able to not have to struggle, not have to worry. So every month, that's $500 per month that she has earmarked, period, point blank, that are being invested for her 2 children. And she was very thankful for us having this discussion. She's known about stocks for a long time too, but sometimes it just takes that extra push. And reminder, if you need extra coaching on this, if you need a community to help hold you accountable, the links will be in the description. I offer one-on-one counseling sessions. They're discounted through January at $79. The price will go up in February. And it's a great way for us to outline steps to get you to execute on this, or even understand how to research companies more. So we'll do a 20-year example and then be done. So yeah, so we did 2007. Let's take it to 2002. So from 2002 to 2022, if you would have initially invested $1,000 and each and every month contributed $200 in in Unilever, in Microsoft, in Sony, in JP Morgan Chase, in Ulta and Nike. These are not high risk companies either. Ulta may have been just simply because it was a newer company, but the rest of them, these companies are standard staples in our lives. Start of year must be before or equal to end of year. Oh, this would be 2022. My bad, y'all. So 20-year return on these staples, these companies, these products that we use on the regular. What is going on? I just keep these. Okay, there we go. 2002 to 2022. Let's analyze before portfolio. Let me just make sure 2002 to 2022. I don't know why this. Let me. Okay. 2002, 2022. Why is this? Does this only go? Give me a second, y'all. I'm just trying to see something because it's not. It's not. And there might be. It might be because. Let me try taking Ulta out of here. Okay. And putting. Let me put another company in that I know. Let's do J&J. Okay. Let me see if I could do 2002. Okay, yeah, it was Ulta. I figured because Ulta wasn't around in 2002, and sometimes it'll let you know which company it is that's making it act funny. But I just put J&J, and J&J is another company that has it's been around forever, and you know something we use, products we used all the time. So I just substituted Ulta for J&J. But if you ever come across that where it's not uploading, it's one of the stocks that probably wasn't around in 20 years, 20 years ago. And that's the problem. But let's just get back to the important stuff. So the initial investment, $200 a month, which equals $2,400 a year for 20 years. So we're talking 24,000 times two. So that's 28,000 plus, excuse me, that's 48,000 plus 1,000, 49,000 would have gotten you $278,000. And it's listen, a lot of us throw away $200 without even thinking about it. A lot of us Uber Eats $200 on a weekly basis. So I just want us to start thinking critically on how we can find this money to invest without any questions. And that's where your investment plan comes. You have to stay true to your plan and your goals. And 20 years, if I could take $50,000 and turn it into more than make 200 and something $1,000 without doing anything except putting the money in the market and letting it work for me, I'll do that all day, every day. And again, let's just quickly look at the worst year was a 31% down year. And I believe that was probably 2008. But the best year was 36. And so, again, there's a dip in 2009 with this portfolio, but we continue to go on the rise. And there were a few with this particular portfolio and J&J substituted. We looked, yeah, there were years that the value of the portfolio went down or only went up by 1%. But all these other great years of returns make up for the down years or the years that it was stagnant. So long term is the best term. That's what I want you to walk away with. I'm going to stop sharing this and see. Hopefully, I hope that was helpful. Again, if you don't remember the site, just rewind this video. If you're watching it for a second time, watch it on a higher speed. I do it all the time. Watch it at 1.5 speed. You'll get through it quicker. You'll probably still understand. But if you have any other questions, definitely put them in the comment section. All of the links are in the comment section, in the description section. And again, I'll be back tomorrow to walk through the tools of investing. I want us to get this right and make our goals for 2023. What are your financial goals starting in January? Like, we should start now. Like, I don't believe in New Year's resolutions, but once you get the information, it's time to educate and then execute. Let's not wait. It's critical. We learned in part 1 that this wealth gap is only going to get greater if we don't take drastic actions. And even, like I said, if we're thinking about gifts for this year, holiday gifts, make sure they're gifts that are assets versus liabilities. I said before, experiences and stocks. And also the gift of books and reading. Like, I highly recommend this. And the Four Agreements. I give these 2 books. Well, I've been giving the Four Agreements, but this has been added to my repertoire. And I walked into a friend's house, and unexpectedly, she had it like literally on her door. I mean, the table by her entryway open, and she reads it every day. And also said her boyfriend like steals the book from her and tries to read it. So again, thank you for tuning in today. This was impromptu. Also, I'm wearing my woke merchandise, y'all. I told y'all I love a good quality hoodie. When I tell you, cotton, great cotton. It says stay woke, wealth obtained through knowledge and education. You can get this also. The link is in the description below. And yeah, thank you for tuning in. Thank you for joining. Thank you, Clodo. And I'll be back tomorrow. So join me tomorrow. Watch the replays. Share this information with a friend. Talk about it with a friend. Start having these conversations. Let's normalize talking about investments in the stock market versus what's going on with Diddy or like, I'm just so sick of us consuming gossip versus educational news that will turn our lives around. So yeah, so I'm very passionate about this. Let me get off because I could go on a tangent, but thank you guys for tuning in. I will see you tomorrow. Take care. Bye.